Hello and welcome back to The Note. We are at the end of the month and we have a huge amount of economic data to come by the end of this week, so it's a good point to take stock. In particular, two questions for today. One, why is the euro looking so strong when at all other times you really would think it would be weakening at this juncture? And secondly, are people now so confident in the US growth story that we are really beginning to see markets driven by hopes for growth rather than by liquidity? With me now to discuss these very meaty topics is the Head of Research for Wealth Management at Credit Suisse, Giles Keating. Giles, thanks very much for joining me on The Note today. Let's start by taking a look at the euro against the dollar. And this is really quite a startling chart. You can see obviously the euro, the red line there, is doing extremely well against the dollar, and yet that's in the face of ever widening gap in the dollar's favour, in the gap between Treasury and Bund yields. You'd expect these charts to be lines to be going in opposite directions, but they're going in the same way. What is going on? Why are people buying the euro?
It is a bit of a mystery. I mean, we know that the euro runs a big current account surplus, which helps the euro, of course. But as this chart is really showing us, everybody is anticipating quantitative easing, or at least some form of easing in Europe, and we're just not getting there.
Okay. What other reasons might there be? I mean, we have the winding down of the crisis, or the apparent winding down of the crisis. Are there any perverse effects as people buy peripheral bonds rather than bunds?
Yeah, I mean, we are clearly seeing a flow out of bunds into peripheral bonds. And I mean, that's been one of the big and successful trades in the first quarter. Whether that's actually been pulling capital in from outside the euro, from the dollar area, perhaps that could have been one of the things going on here.
And another question we always have to ask when it comes to currencies is about the central banks. I mean, Mario Draghi at the ECB does seem to be prepared to admit that he's at least paying some attention to the euro, which is something central bankers don't usually do. And we have the very interestingly poised situation in the Fed. How are the central banks' dilemmas feeding into this?
I think they are very important, actually. I mean, we did see, after all, Janet Yellen making that statement about raising US rates 6 months after the end of QE in the US, and then she kind of retreated from that. And if one was a conspiracy theorist, one would notice she began to retreat just a few days before an ECB meeting, and it was that very ECB meeting where Mr. Draghi didn't directly criticise the Fed, but he did, in the questions, criticise the IMF for telling the ECB to be a bit more proactive.
Okay, so there is some sense that there is pressure on the ECB. Let's take a look at another chart. This is a fascinating chart, which I'm glad you brought to my attention, showing the spread between yields on Irish bonds and on UK gilts. It basically says that the crisis in Ireland is completely over.
Well, that is clearly the message here. As always in markets, there may be a little bit of froth, a little bit of overexcitement, but I think that is the big message here. Really, investors have completely normalised, and I mean, this is really quite an extraordinary chart, I think.
And you get something similar if you look at Greek bonds. The Greek long bonds have now recovered all of their losses since the dawn of the crisis back in 2009. Is it really true that the risk of euro breakup is now over? I mean, have the geopolitical situation made sure that the euro is going to hold together, do you think?
I think all of the economics points to the crisis now being over, even though we've still got some worries, say, about Greek debt sustainability. But I think the geopolitics adds a whole new layer. Could really the euro be allowed to break up given the instabilities towards the east? I think it couldn't, is the answer, not now.
So it really has been ruled out as an option in the last few months. Very quickly, let's also take a look. You've been written a lot at the beginning of the year about how we would see a move during this year from a market that's primarily driven by liquidity to one that's driven by growth. Arguably, you can see some signs of that, if not unambiguously here. Biotech, obviously one of the ultimate liquidity plays, having a sharp correction recently in value, doing better than it has been. Are we at a turning point, do you think?
I think this is definitely a canary in the cage. Even if we're not literally at that turning point from liquidity driven to growth driven, we're definitely getting much, much closer. And I think this sell-off in biotech stocks and IT, accompanied by a little bit of a tick up on the value side, I think that is a clear signal. And after all, the economic data, we were a bit worried in the first quarter. I think now we feel more relaxed about growth.
Okay, Giles, thank you very much indeed. Obviously, we have a very interesting setup going into data later this week. People really are beginning to get very confident that the US growth story is real, that the interruption was only down to the weather. We will start to get much more evidence about that in the next few days.